Hi, I'm Martin McGrath from Financial Leadership, and today I want to answer a question around what happens when I die and I pass on my investments to my kids. Do I have to pay tax? How much tax? How does that all work? So my background is I'm both a financial planner with a master's degree, as well as being a tax agent and accountant with a chartered accountant qualifications. So we're well equipped to answer these questions. And it kind of depends. I'm going to put this into kind of three different segments as part of this discussion. And that is your personal assets, that might include your home. That's bucket one. Bucket two is your investment assets. That might be a rental property, some shares, that kind of thing. And third bucket is super. This is worry about house personal assets. So generally answer to that question is no. Not much tax to pay on any personal assets. So if we pass on the car to the kids, don't have to pay any tax. We have the furniture, all that kind of stuff, no tax typically gets a portion to that. Your house that you live in, if it's your principal place of residence, you've lived there for 10 or 20 years, even if you bought it for 300 grand and now it's worth $1 million, you've made some money on it, you've lived in it the whole time, you haven't rented it out, you pass it on to the kids, generally there's no tax that's attributed to that. It's important. But there is a timeline about what the kids do with that. Are they selling it? How quickly are they selling it? Someone going to keep it as investment property because those rules can change. And there's a 2-year rule that's important to plan for. Might not be your problem because it'll be the kids' problem, and vice versa. If you're receiving this and you're watching this video, make sure you've got a plan around what are we doing with that property. We've kind of got 2 years to make some decisions. We sell it generally within 2 years, no tax. If it goes beyond that because we're not sure what we want to do, we're renting it out or somebody else living in there, what's happening, there's particular planning to make sure that's set up the right way. Cash kind of also falls into that personal assets. Cash isn't viewed as an investment because typically there's not a lot of capital gains you can get with cash. So if we've got $1 million in a bank account, pass it on in part of the will, typically no tax is attributed to the cash because there's no gain made. If we're earning interest on it, sure, but that's income, but the asset itself, typically no tax. Let's go to the second bucket, investments. Do kids pay tax on investments? The short answer is yes, but it's not paid as part of your will in the estate. It's not paid straight away when any of the beneficiaries or kids receive these funds. I say kids, this could be adult kids, this could be 40, 50, 60-year-old kids, but let's say beneficiaries. And the typically tax is paid when that asset is sold. So if we had a share portfolio, we had 500 CommBank shares, you own them for a number of years, pass them on to the kids continue to hold them. Is any capital gains tax paid through that process? No, there's not. But let's say a number of years later, they get sold, well then there is some tax to pay on that. Whether they sell it on day one, whether they sell it in 10 years down the track, it doesn't matter in terms of timing generally. There's no 2-year rule like there is on the house. There's generally tax attributed to that. There is a special rule around pre-CGT assets. So if you've got a lot going on, best to talk to a specialist or an advisor. But typically, yes, there's tax on investments. That might be an investment property, might be shares, might be a managed fund, all that kind of stuff. Generally, yes, there's tax to be paid on that. Therefore, some proper planning, both from you for the future, as well as the children when they receive it, about when they sell it. Do they sell it all in once? Do they sell it in the estate? Do they sell it over a few years to minimize the tax? Who gets those assets when they all get split up? Some proper planning can save a lot of headaches and a lot of tax throughout that process. But yes, generally that second bucket, if we're labeling this as an investment, tax could apply to that. Third bucket, super, perhaps even perhaps the most complex out of all this, and I've done a whole nother video talking specifically around super, death and tax, but the short answer is yes, tax can be attributed to super. It depends upon how your super's set up, your taxable portions, all that kind of stuff, but generally the answer is yes. Tax can be apportioned at up to 17% on the balance. So the more significant the balance, the more significant that 17% could end up being, tens of thousands of dollars potentially. And all of these options, bucket 1, 2, and 3, there's some planning to make sure we do. There's some ways that we can minimize or spread out the tax with some proper planning. But it is important. The question I got was, what happens when I die? Do my kids have to pay tax? The general answer is, well, it depends what they're inheriting. But if there's any super, if there's any investment assets, they definitely need to have a plan about how they're best structuring that to understand the tax before they sell it, and if there's any strategies they can do to reduce that or spread it out. Hopefully that makes sense. If you want to discuss any specific questions around all this, feel free to reach out. Jump on the website at financialedgegroup.com.au and find the contact us button and let's have a chat. If you've got a particular question about your situation, feel free to pick up the phone, have a chat with us, or jump on our website at financialedgegroup.com.au.